Good day, everyone. So today we're going to be dealing with the market maker model, and I'm going to be explaining the concept behind the market maker model and how you can use it as a trading strategy. Some of us may be familiar with the market maker model, and we have to understand that we have the buy model and the sell model. This diagram we see here represents just the buy model. The buy model is just price moving down to go up. Then for a sell model, it's price going up to go down. Now, when we talk about the market maker model, it has to do with three things. Now, what are they? An area of consolidation. Let me take this out. It's simply price movement from an area of consolidation to an area of liquidity. So liquidity here represents old lows or highs, order blocks, breakout blocks, fair value gap. So it doesn't just mean old lows. So just an institutional level. And then back to the original consolidation. So those are the three things that are involved when it comes to the market maker model. Now, as price moves from these 3 points, that is point A, so I'll name this point A, here point B, and then point C. Now, along this course, price usually consolidates in between. Now, you might get one consolidation or two, or we might even get three, but you don't usually get much consolidation because price is in a hurry to achieve the goal. Now, I'll explain that later as we move ahead. But I want you to understand that between point A and B, that is the area of original consolidation to the area of institutional level or liquidity, there's usually a consolidation, giving an opportunity for you to enter this movement. Now, once price gets to our area of liquidity or institutional level, that's point B, there's what we call the smart money reversal. There's usually a reversal here, and then price rallies to the original consolidation. And before it gets to the original consolidation, it gives about two opportunities, three, or just one. Now, these areas we see here are points where we can capitalize to take trades and even at the area of consolidation. So usually this run here, you might miss it. But this here, once you see something like this for a buy program, it gives you further confirmation that we are in a market maker model. Having this backlogged, it gives you the confidence to take this trade because you know that price is moving from point A to point B and then back to the original consolidation. So you are trusting price to give a little consolidation here for you to enter here. If you miss this, you'll be taking this for you to capitalize on the trade to take this highs. I hope we get this. So I'll come again. The market maker model deals with three components. We have the original consolidation, price movement to an area of liquidity. At this point, we have the smart money reversal, and then back to what I call the point C, which is the original consolidation. So from point A to B to point C. And then along this movement, we have consolidation, little consolidation that gives opportunity for you to enter the trade. So you can be a trader who will see this and then capitalize on this move as price falls, and then capitalize on this move as price rallies. All right. For a buy model, we call this side here is what we call the sell program. And then the other side is what we call the buy program. And the opposite is the same for a sell model. Now, there are four things you have to consider when it comes to identifying a market maker model. Number one is context. You don't just look for price moving from up. Let's say we assume here's point A to point B, then back to point C. Don't just look for something like this. No. Although that's where the structure is coming into play. You have to be able to identify how it looks. So like I said before, the first thing is what? Consolidation. And we are expecting price to move away from that consolidation and then give a little consolidation here for you to capitalize on the move downwards, because there should be something here, either an old low, another block of fair value gap of which price is running towards, And then once price gets to that area of liquidity, we're expecting what? A market shift. And as soon as market shifts from a sell program to a buy program, we're expecting what? Another consolidation here for it to capitalize as price rallies to take the original consolidation, this high here. Help you understand. And that's what structure tells you. But one very important thing is the context. You don't just look for this on your charts. No, you want to start with a context. Why do you think price will reverse here? What if price keeps going lower? So that's where context come into play, where you want to look at the whole general bias, market structure, and institutional order flow. The other two factors we want to consider is the time frame and the institutional order flow. Now, I'm going to talk about this as we move further. I won't be able to explain it here because I'll need examples to talk about what this means. But first of all, you have to understand context, very important. Why is price going to where it's going? What do you think is going to happen when it gets there? Then the next is structure. You have to be able to identify the original consolidation as price moves away from it. Either a sell program or a buy program, price might actually move upwards. So are you considering that if price gets to this point, it will reverse? As a rallies, you're expecting something to happen here to give an opportunity to enter. And then once it gets to your objective, you're expecting what? Smart money reversal. And as soon as price reverses, you are expecting something here again, or maybe even something here, something. You may get two opportunities or just one before price takes this low. So that's just context and structure. And the next is time frame, and then institutional order flow. We'll talk about these two as we move ahead. All right, so let's look at an example. Now, looking at the context here, overall, price is bullish. We can see price just retracing to take liquidity and then resume the original price direction. So when we go to the next slide, we'll understand better about context. And then for structure, you can see how price consolidated here, left the consolidation quickly, took out this liquidity. So I said from point A to point B, and point B is usually what? An area of liquidity. Point A is the original consolidation. So the first thing you're looking for, if you want to identify the market maker model, you want to see price consolidate and then leaves that consolidation heading towards an area of liquidity. Now, that area of liquidity represents an area where price usually will bounce off to rally higher if we're in a buy program. If we're in a sell program, we want to see price consolidate, leaves that area of consolidation, move to an area of liquidity that represents an area price is most likely to bounce off from to take the original consolidation that was made here. I don't know if you get that. So we are blending context and structure together to give us an idea of market maker model happening. All right. So overall price is bullish. You can see price created what? Consolidation, rallied lower, took out the sell side liquidity, and then resumed the bullish trend. So you might not see this whole down move here. This is this side here. You may not see this. So if you missed this, because this already is saying that, okay, wake up, we're in a market maker model, you can capitalize on this. And then there are also traders that would see this consolidation and just seeing this consolidation, they know that price is actually going lower to take this sell liquidity before resuming the original direction. So they might capitalize on this move and as well capitalize on this move. So you don't have to know how to capitalize on the two. You just need to know how to capitalize on just one. It may be a trader who can identify the sell side quickly. And we can see how price is taking liquidity. So this is the sell side delivery. And there's the buy side delivery. If it is a buy program, the left side here is the sell side. It's just very simple. You can see how price is running lower. So this is sell side delivery. This is the buy side delivery. Okay. So we can look at the price in candlesticks. You can see how price rallied downward swiftly, took out this sell side liquidity before rallying higher. So this is an uptrend. I want you to look at the left. There's something here. There's a fair value gap. You can see how price as it took out this liquidity, the sell side liquidity, it was filling in this fair value gap. Now, this is context. You understand that price is still bullish. This high has not been taken. This high has not been taken. Price consolidated, fell, took out the sell side liquidity, filled this fair value gap, finding support where this order block, this bullish order block, and then rallied. This is context. Okay. So this is a 15-minute time frame. Now we can see price action clearly here. You can see how price consolidated, left the consolidation. Now you may not get an opportunity as price is leaving this consolidation, but there may be something here for you to capitalize on as price rallies lower. Took out this sell side liquidity, and then if you look at this point here, there's something here. This consecutively down close candle is a 15-minute bullish order block, and then here is what? A breaker block. And you can see how price found support, and then there was a reversal here. This is what we call the smart money reversal, and it rallied. Okay, so like I said before, there are 4 things involved. You want to bring in context, you want to bring in the structure. Identifying the structure is very important as well. And then the next thing is the time frame and the institutional order flow. So I've not explained the last 2. All right, so let me go about the last 2 here. So here's a 3-minute time frame. This is our original consolidation. You can see how price left and then took out the sell side liquidity, finding support in the breaker block before rallying. So I want you to look at this chart and tell me what you can see. How would you have taken trades? So this brings me to the 3rd point, which is the time frame. Many people may know about the market maker model, but they don't know how to use it as a strategy. So one way to explain it to you is how can you use it as a strategy? How can you actually apply it to your trades? Next, you want to understand is the time frame. What time frame can you use? Now, the time frame you should use is the time frame where the institutional levels are clearly noted. Institutional levels are your premium and discount arrays, your order blocks, your fair value gaps, your breaker blocks, your rejection blocks, and what have you. So if you look at this time frame here, let's go back to the 15-minute time frame. You can see how price left this consolidation and the price wasn't reacting from any institutional level. You can see fair value gaps here, where price did not react. Even as well here, you can see just little reaction. Let me expand. You can see there's a fair value gap here. Price reacted, and then fair value gap here. So we can see little institutional levels here that price is reacting from. So if you want to participate in this market movement, you wouldn't want to be using this time frame for entries. So this is the what? 15-minute time frame here. So you want to go to the time frame where you can see the institutional levels clearly noted, clearly visible to you. So we'll go to the 3-minute time frame. As you can see, as I outlined here, there's a fair value gap here. It's very little, but you can see how price reacted from this fair value gap, created another. This is the sell side now. You can remember I explained before. There's the sell side of the curve. This is the buy side of the curve. Price fell, took sell side liquidity, and then rallied. So there's the sell side of the curve. This is the buy side of the curve. So in the sell side of the curve, you will note that price reacted from this institutional levels, which is the fair value gap here. And then we can see a fair value gap here. And then market turned. At this point here, you can see how price rallied. And then reacted from an inversion fair value gap. Because we all know what an inversion fair value gap is. Once price breaks through the fair value gap that was created on the left side, it becomes an inversion. Usually, we're expecting price to fill this fair value gap and then fall from it. But we can see how price reacted and then broke through it, then found support. So it is resistance turn support. Okay. So you can see here, price reacted, broke through it, and then found support here. So this is an institutional level. If we go further, we'll see here is an order block. See how price found support and then rallied. Here again, we have an order block. So you can see that the institutional levels are clearly noted. So that's the time frame you want to be using. You don't want to be confused on what time frame to use. Should I use the 15-minute time frame for entry? Should I use the 5-minute time frame for entry? You want to use a time frame that has the institutional level clearly noted. Then now the last point that has to do with the market maker model is the institutional order flow. Now, what's the institutional order flow? The institutional order flow is when the institutional levels hold price till the algorithmic liquidity is achieved. Now, what do I mean? Let me explain. Now you can see that price was on its way to this high. Now there's a liquidity above this high, price is running towards. Now every institutional support level held price from going lower until price reached this buy side liquidity that is above the original consolidation. So if you look at it here, as soon as price turned, it rallied. Found what? An inversion fair value gap, price found support and it rallied. Now, in this inversion fair value gap, we have what? Consecutively down close candles here. So I'll expand. This is what? A bullish order block. You can see how price found support and then rallied. There was another order block that was created. You can see how price found support, taking this sell side liquidity, filling in this fair value gap, and then rallied. Taking what? The buy side liquidity above the original consolidation. You can see how price keeps finding support where? In the institutional level. So now, so when you're working with the market maker model, you want to work with the institutional order flow. Because once you see price rallying like this, you might be scared. Because maybe thinking, what if price only rallying to just continue going lower to take this low? Do you understand? You might be scared. So the thing you want to apply is the institutional level. One very thing you have to understand about the market maker model is that you have to trust the institutional order flow. Because once you see price rally like this, you might be scared to sell somewhere here. Because what if price wants to rally lower to continue this trend, maybe something like this, and then run lower? You may not be thinking that price wants to continue going higher. So once you see the institutional order flow in action, is a telltale sign that price is on a buy program or a sell program, whichever side you are on the curve. So this is a buy program. You can see how price rallied higher. So if you keep seeing price reacting from institutional levels, it's telling you that the institutional order flow is bullish and we are in a buy program. You can trust this. So when working with the market maker model, these 4 things are essential. Number 1 is the content. Number 2, structure. Number 3, time frame. And then number 4, institutional order flow. You have to see these 4 components at work. You have to be able to understand this 4 components in order to utilize this model. All right. So I'll go over this again for better understanding. Like I said before, you want to see price consolidate and then leaves the consolidation. As soon as price leaves the consolidation, you want to look for areas of liquidity where you expect price to reverse. And as price is moving towards that area, you expect little consolidation for you to capitalize on for a trade. So you can see here, there's a fair value gap here that price retraced into before rallying. And once price gets to that area of liquidity or institutional level, we're expecting a smart money reversal. Now you can see how price broke structure here. It broke this high and then filled this fair value gap and it rallied. This is what we call the smart money reversal. There's a reversal here. Now you can also use the smart money tool where you note divergence between correlated assets. It's also a tool you can use to tell a price wants to reverse from an area. And you can see how price rallied. Now, once price rally, you have to note the institutional levels using the time frame where you can clearly see these institutional levels. So you can see here, price reacted to this fair value gap, broke through it, turning into what? An inversion fair value gap. As you can see here, price found support. On finding support, it created what? A bullish order block. Price rallied, came down, find support in this bullish order block, and it rallied. At this point here, giving another opportunity. So this is another minor consolidation here. You can see how price retraced back into this fair value gap, filling this void, taking this low, and then rallied. So now let's go to another example. All right, so here's another example. You can see price taking out this buy side liquidity. So here actually is a reversal, it's a market reversal. It's not like the first example. The first example was a market trend, but here you can see market reversal happening. Price took out the buy side liquidity and then reversed. Okay, here's the buy side delivery, and then here's the sell side delivery. So let's talk about the context to this trade. So here is the buy side liquidity. Price rallied, took out this buy side liquidity, and then fell. But before getting to this point, there was what? Consolidation here. You can see this little consolidation and the price rallied. So once you see price consolidate and then a quick movement away from that consolidation, you want to prime your mind expecting a market maker model to form. Once you see this consolidation with this buy side liquidity, you could as well expect price to move towards this high. Maybe you may not know that price will reverse, you may not know about that, but you know that price wants to take this high. So what happens? You capitalize on this trade. But once this high is taken and you see a reversal here, you can as well further capitalize on it. Or even if you don't take a trade here, you see a reversal here, usually price will give you something here at this point here. After this high has been taken, and there's a reversal here, you expect that as soon as price begins to drop, there will be something here for you, because usually there's a consolidation in between these points, point A, point B, and then point C. So usually between this point is a consolidation. So you just want to identify these three things here, very importantly, when it comes to structure. And then you want to also add your context. Don't just look for something like this. You want to know, why is price going to this point? Why do you think price will reverse? I hope that's clear. Okay. So you can see this high has been taken. This is the buy side, and then this is the sell side delivery. Okay. Another thing again I want us to also note is what? This order block. See how price consolidated, found support, this order block. Right. This is context. This is context, guys. So price consolidated, took out this low, found support here on this bullish order block, rallied, took out the buy side liquidity, forming the buy side delivery of this market maker sell model, reverse, and then fell, forming what? The sell side delivery to take what? This original what? Consolidation. Okay, so let's go to a smaller time frame. The previous time frame was a 1 hour time frame. Here's a 15-minute time frame. Now, like I said before, the time frame you want to use for entries is when you see the institutional levels clearly noted and price reacting from that level. So you can see here there's a fair value gap. Price did not react. Price did not react. Now you may be asking, do I have to now wait for one side of the curve to be completed before I use the other curve if I'm picking a time frame for entries? Because for picking the time frame for entries, I have to see price reacting from an institutional level. No, you don't necessarily need to do that. If you look at price consolidated here and then rallied, because that's what you're waiting for. You want to see that rally. Now, you may be very good to know that, okay, price wants to rally and then maybe enter from this point. I really don't know. But one of the safest ways, you want to see that quick movement away from consolidation, because after consolidation, we're expecting what? Expansion. So that expansion, you want to outline that institutional level that you can see. And once price doesn't get to that point, you can go down to a smaller time frame and then identify the institutional level you can see for you to enter. Now, even if you miss out in that trade, you shouldn't worry, because markets or trading is all about probabilities. There's nothing for sure. So if you miss a trade, you go and wait for another opportunity. If you get an opportunity, you enter again. All you want to be doing is to be trading with high probable opportunities, because you want to work with an edge. What do you see in price action that tells you that market is most likely to go this direction? That's all trading is all about. So here we can see this is a 15-minute time frame, price consolidated and rallied. There's not any institutional level of note here. So what happens? We go to a lower time frame. Good. So here's a 3-minute time frame. You can see this is the original consolidation. See how price to the range and then price continue to move within this range and it rallied. Now the first thing you will note here is what? A fair value gap. So let me expand so you can see it clearly. Here is a fair value gap. Price found support, rallied. Another fair value gap, price found support, rallied. So I just want to identify the institutional levels in this time frame to let you know that this is the time frame you should be looking for entries in order to use or implement the market maker model as a strategy. So let's look at this with lipsticks. Good. Now you can see the original consolidation like I explained previously. You can see how price rallied. What is this? A fair value gap. Let me expand so we can see it clearly. Okay, let me take out my drawings. So you can see how price found support with. Okay, I didn't identify this fair value gap. Here is not a good entry point. But you can see how price found support here, rallied. This consecutively down close candles and order block. You can see how price found support and rallied. Although I named it a fair value gap because you can see fair value gap here. Price filled in this fair value gap and it rallied. On filling it, it created what? A bullish order block. Price rallied, came back down, found support in this bullish order block, and it rallied. What can you see here again? This another order block. You can see how price rallied. Once liquidity was taken at this side here, at the left side here, we had what? Smart money reversal. Now look, let's look at this. You can see how price took out this high here. So we can see here. Let me draw it out. See how price took out this high, then broke structure to the downside. This is a shift in market structure. So as it broke structure, it created what? A fair value gap. Price ran into that fair value gap, filled it completely, and then fell. All right. So you can see at this point here, you could be entering here. As soon as price shifted, you'll be entering. This is what we call your low risk sell. You're selling. But price gave another opportunity. Again, this is a fair value gap. After breaking this low, price retraced into this fair value gap and then fell. In doing that, it created what? Another fair value gap for another opportunity. It fell. Now you can see how price keeps respecting what? The institutional order flow. And because we're in a sell side delivery, price keeps respecting what? The institutional resistance levels. That is the bearish fair value gap, the bearish fair value gap here. And then you can see here there's a breaker block. This consecutive down close candle. Price took out the buy side liquidity and then broke structure. So you can see how price found support and then rallied. And then here again, you can see how price filled this fair value gap and then rallied. But I need you to note that you don't want to keep selling as price keeps going lower. Okay, let me explain what I mean. You can see here, here's the best opportunity you can get. As price continues to go lower, the probability continues to decrease. So once I get 1, 2, 3 opportunities, I'm less likely to take the 4th opportunity. Although we can see how price fell beautifully here. So I hope this was helpful. Please, if you have any question, leave it in the comment section. And if you enjoyed this, please like this video and share it to your friends. And please subscribe. All right. I wish you good luck and good trading.